Winston, it's really good to see you. Today, we are talking about a smart alternative to high yield bonds. 2022 was a really tough year for investors, and a lot of us may not realize that there are strategies that a lot of the pros utilize, which are a great complement to traditional stocks and bonds. So, today, we are talking about structured notes. What is a structured note?
Structured note is an interesting concept. Okay, it in many respects it's a product, very much like a mutual fund is a product, an ETF, exchange traded fund, is a product, and a structured note is also a product in the same breath. Except the primary difference is that the structured note has its origins in investment banking,
Mm,
and basically what it is, it's kind of a combination of a bond plus a derivative, okay, or an option, put another way, equals a return, a risk return profile that is very unique, okay? And that's what a structured note is. And we have found these structured notes to be very good at augmenting, that's the key word, augmenting someone's portfolio to try to give them the most appropriate balance to that portfolio and their outcome.
hmm No, but Winston, this isn't something that I can go down to my local credit union and buy, right?
No, typically not. This is something that's actually kind of obscure in the financial world. It's something that you're not going to walk into Bank of America or your credit union and ask them for a structured note because, frankly, they don't even know what you're talking about.
Yeah.
What happens in the structured note world is there is something called capital markets desks that exist at the big investment banks, companies like Citibank, Bank of America, Goldman Sachs, Morgan Stanley. They have these capital markets desks, and they actually reach out to our RIA companies, like in our case, Brookstone Capital Management, and they offer this bond and this derivative structure that we can then take and offer to our client base with the intent and purpose of augmenting and enhancing their overall portfolio.
hmm Okay, so there are three kinds of structured notes. So we're going to break them down a little bit. And I really love this visual, Winston, because it helps us understand the relationship between risk and return. But let's start with principal protected notes. What are they?
Well, principal protected notes are very much what they sound like. Okay, your principal is protected. So you buy this note, and these notes come in different terms, maybe a 1 year note, 2 year note, 3 year note. But we typically hone in on 1 and 2 year notes. And what they do is they're something that's good for a person who wants to grow their money but not have the risk. Maybe they've got money. If you look down below that, you'll see fixed income and you'll see cash.
hmm
So when you have people sitting on the sideline, like in a lot of cash, and this is something that we've been seeing more and more of because people are terrified of the
Right,
markets. And
right.
when they sit in cash, the scary part about sitting in cash is that the inflation is destroying the buying power of that
Right.
money. Even though it's safe, it's really not safe. And there's an old saying, Aaron, that money is never sitting still. It's either going or growing. Okay, so the principal protected note is great for someone who's sitting on the sidelines or wants to get some decent growth, but without that risk. Now, you do have some creditor risk, with the issuer. And so if your creditor is Citibank or Bank of America, it's kind of nice to know that they're big, strong, stable companies, but there is that little element of risk.
Okay. And the next structured note here on this spectrum is income or yield notes. Who are they for?
Well, yield notes, I love. They're very fascinating to me. And again, issued by one of the major banks. And what they do is they use a coupon rate. Okay. And these coupon rates are fantastic. These yield notes, they we'll see yields 7, 8, 9. We've seen some that are even in excess of 11%,
hmm
where you buy the note for a period of time, and along with it comes this yield, and it's a fantastic way for your money to work for you to keep you ahead of inflation and keep the buying power of your investment good.
hmm
Okay. One of the things about the note, though, is that they have a a downside, if you will. Okay, there's a protection element that says if you buy the money and you're earning 7, 8, 9% yield, there's got to be something to it. So there's an underlying market that's associated with it. The S&P 500, the Nasdaq, the Dow, the Russell 2000, whatever the combination of those are, they have a 30% downside. So if any one of those indices falls more than 30% in the year, some of your principal might be at risk. But when you think about it, the markets right now are down 15, 20%.
Right, right.
Do you think there's another 30% drop in there for us? So this is what investing is about, is what you think is going to happen. And if you think that a 30% buffer downside is a safe bet, it's a very powerful tool for you to get greater cash flow into your portfolio.
Okay, so the third option here now, growth notes. And Winston, you mentioned people sitting on the sidelines because they don't want to be involved in the volatility right now of equities, which we do see to the farthest right on this risk spectrum.
Right. Well, I like the growth note. And again, not any one is perfect for everyone. Sometimes we'll do a combination of them. But the growth note, I kind of liken to a indexed annuity product, okay, where your principal is protected against loss, but you have an upside cap. Unfortunately, in the fixed indexed annuity market, the caps are 4 or 5%.
Right.
Okay. So in a growth structure note, you might be seeing something on a cap on the order of 15 to 20%, for the year, or maybe over a 2-year period. And then they have buffer on the downside. So while they don't guarantee a floor of 0, if you have a 9% downside buffer and the market drops, say 10%, the S&P drops, for example, 10%, you only lost 1. Okay, but it's a nice trade-off to have that much higher cap on a growth structure note than and a nice buffer on the downside. This allows people to reinvest in the markets and be more comfortable that they're not, hanging it all out there at risk.
Right, right. It's all about sleeping at night, Winston. I know you want your clients to sleep well at night.
Yes.
Just to underscore why we're
if our clients sleep well at night, we sleep well at night.
Exactly. Exactly.
Right.
And I just want to reiterate, though, why we're talking about this today. You've mentioned inflation, right? That's it. Your cash is losing buying power the higher the inflation rate. And also the traditional portfolio, Winston, the 60-40 portfolio had one of the worst performances since the 70s. So that's why we have to be talking about these other strategies, right?
That's right. That's absolutely right. And so these structured notes bring a breath of fresh air to the conversation for our clients. And when it's something they haven't heard about, it's something new, it's something exciting. It's not completely new. It's obviously been around for some time, but we are moving into the arena where we're able to talk about this with our clients to a level of sophistication that we feel that we can present this, build this in to their portfolios by perhaps having a sit-down meeting, looking at their portfolio performance, maybe looking to rebalance. And our team at Brookstone just does a fantastic job supporting us and helping us to rebalance clients' portfolios.
Right. And again, I know it's very important to you that your clients understand what they're investing in. So I want to touch on a couple of the risks associated. You hit on some of them already, which was issuer, you've touched on that, but also term, return profile, and level of risk. What do we need to know here?
Well, again, it's who is it that's issuing this note? And so I've got my notes here. You have your Citibank, Bank of America, Goldman Sachs, Morgan Stanley, JP Morgan. They're the issuers. Okay. Their capital markets desk reaches out to our team at Brookstone, like with our chief investment officer, and they say, hey, we have a great opportunity. That flows down to us as the investment advisor representatives for us to share this information with our client base. The term is another very important part, Erin. How long am I going to be in this investment? And they come in several flavors, 1, 2, and even 3-year notes. But as I mentioned before, we really kind of hone in on that 1 and 2 year note. We like to build ladders with these things for people as well. The next thing is, what's the payoff? What is the return or the coupon rate? Okay. We want to look at how much money can I expect to receive relative to the level of risk, which is the fourth item. Okay. And the level of risk on these notes has to do with the underlying indices and the performance of those indices over that 1, 2, 3 year period. And we talked before about a 30% downside buffer. It's pretty powerful.
Right.
It's a pretty
Right.
powerful buffer, especially when you consider where you're starting from. Great time to get off those sidelines.
Yeah, no, I'm really glad we're having this conversation today, Winston. It's very helpful to walk this through. Again, I think it's important for people who have any questions about this because it's kind of complicated and a lot of people don't know it even exists. So,
I
Winston, if
know.
somebody has questions about it, what's the best way to reach you?
Well, you can always call us here at the office, 602-456-1928. 602-456-1928. You can go online to our website, winstonandcompanies.com. And there's one of those little Calendly things where you could click on to schedule an appointment and get right on our calendar. But we'd certainly love to hear from you. If you're already an existing client and you want to just get together for a review, we'd love to do that with you. We try to reach out and set those up with as many people as possible. But feel free to reach out to us, and say, hey, I want to reevaluate my portfolio.
Right.
I want to take a new risk profile questionnaire. I want to see if rebalancing is in the works for us. And we've done it very successfully for a lot of people.
All right. Winston, thank you.
Thank you, Erin. Always great to see you.